So what is a partnership? A partnership is an unincorporated business which is owned and run by more than one individual. A partnership, just like a sole trader, where there is one individual, presents its accounts in a statement of profit or loss and a statement of financial position. In a partnership, profits are shared between the partners in the business. The share of profits, however, can vary from business to business. They may be shared equally, or they may differ between individual partners, such as 10%, 30%, or 60%, or they may share profits 50-50. Picture a cake being split exactly in half, and this may help, where one half goes to partner A and the other to partner B. The Partnership Act of 1890 regulates the way a partnership operates and describes a partnership as persons carrying on a business in common with a view to profit. The terms of the Act can be added to by a written partnership agreement. The partnership agreement regulates the way that profits are divided, whether any partners are entitled to salaries or commission, and any interest paid to partners on their capital invested or monies withdrawn. So what are the differences and similarities between a partnership and a sole trader? A sole trader and a partnership both have a capital account, which is the amount invested by each partner or sole trader within the business. Next, a sole trader might have a drawings account, which is used to account for items drawn from the business, whereas a partnership will have a current account for each individual partner instead. Here is an example which shows drawings, interest on capital, interest on drawings, and profit share. Both a sole trader and a partnership use the bottom line of the statement of profit and loss as the profits owed to the owner or partners. If we look at a statement of financial position, this is financed in a sole trader by the opening capital plus profits less drawings. In a partnership, this is financed from the end of period balances of a partner's capital and current account. Also, the profit share is included in the current accounts in a partnership. If one business partner was to leave the practice in a partnership, then the partnership would continue. However, profit shares would be altered, whereas in a sole trader, trading would cease entirely. So what is goodwill then? Goodwill is simply an accounting term for the difference between the market value of a business and the value of the assets and liabilities within a business. This is also known as its net value. For instance, if an individual pays £100,000 to buy another company, but the value of that company's assets and liabilities is only £50,000, then the goodwill is the difference, i.e. £100,000 minus £50,000, which gives you £50,000. So why is goodwill relevant in a partnership then? This is because it is used to reward existing partners for their input into a business, and it does this by sharing the value of this goodwill between the individual partners. This happens when there is a change in partnership or a change in profit share. A change in partnership would be where one partner leaves or joins the business. So in terms of accounting for goodwill, where we have the creation of goodwill, we need to debit the goodwill account and credit the individual partner's capital accounts as per the profit ratio before the change occurred. When there is an elimination of goodwill, we need to debit the partnership's capital accounts as per the new profit share ratio and credit the goodwill account. Let's take a closer look at an appropriation account. So in simple terms, an appropriation account is just a calculation of what each partner is to be paid at the end of an accounting period. The way that this is calculated is by taking the profit or loss at the period end, adding interest charges on partners' drawings, deducting any salary or commissions, deducting any interest on capital, and this will then equal the profit or loss to be shared between the individual partners. Remember, in the financial statements, capital plus profit less drawings equals closing capital. Finally, let's do a worked example. So Bob and Rachel are in a partnership where Bob receives 60% of the profits and Rachel receives 40% of the profits. Here we have some information about the year end, with the current account balances brought forward of £2,000 and £300. The profit for the year is £40,000. We have interest on drawings of £300 and £100. Rachel has a salary of £12,000 and there is interest on capital of £3,000 and £4,000. Once this is calculated by adding the interest charged on the partnership drawing and taking off the salary and interest on capital, we get to a profit available for distribution of £21,400. Bob received 60% or £12,840 and Rachel received 40% or £8,560. Now let's presume that drawings are £12,000 and £13,000 in the year and see what this looks like in a current account. So we have drawings and interest on drawings on the left of the current account as they are debits, and on the right we have the balance brought forward, the interest on capital and profit share. Rachel has a balance carry forward of £240 and Bob has a balance carry forward of £5,540. So I hope you found this useful. Thank you for watching. Consider subscribing so you don't miss out on any future tutorials, and I shall see you on the next video.